Hola a todos, bienvenidos a nuestro webinar que organizamos desde CFA Society Chile con el apoyo de nuestros sponsors, Fintual, Colchester y Vinci Compass, para hablar acerca de uno de los cambios más relevantes que trae la reforma de pensiones acá en Chile. Nos referimos a la introducción de los fondos generacionales. Para esto nos acompaña hoy día la doctora Seda Peksevim, Ph.D., fundadora y Managing Director de Pensión, Research and Consulting, con quien conversaremos de este tema, basándonos en la investigación que Seda publicó en CFA Institute Research Foundation, Optimal Design of Life Cycle Funds in Emerging Market Countries. Her research and this presentation will help us understand how to adapt these funds to the characteristics of an emerging market country, considering human capital and uncertainty. We'll reserve the final 20 minutes of the webinar for Q&A for our audience. And with no more introduction, I want to give the presentation to Seda. Seda, again, thank you very much for accepting our invitation and joining us today at 8 p.m. at Turkey. So we are eager to hear your presentation, your night and our evening.
Uh, Thank you so much, Javier, Pedro, and Natalia, for this great invitation and the organization. First of all, I would like to share my presentation with you, and then I will briefly introduce myself, and then think we can start the presentation. Can you see my screen now? Yes, great.
Yes, we can see it perfectly.
Okay, great. So this was one of our studies under Pension Research and Consulting, which was funded by the CFA Institute Research Foundation for a brief titled Optimal Design of Life Cycle Funds in Emerging Market Countries. First of all, I'm Dr. Seda Peksevim, founder and managing director of Pension Research and Consulting, an independent firm that's based in Turkey but works with mostly Latin American countries, Central Eastern European countries, and hopefully with African countries for pension funds related projects on research and consulting. I am also lecturer at the University of London for finance. So today I'm going to talk about how we should optimally design target date funds, life cycle funds in emerging market countries. I know that I'm also closely following up the Chilean pension fund reform for optimal target date fund design. So I hope that this research will also have some important implications for the new reform of pensions in Chile. So first of all, introduction, because as far as I understand that most of us know only the countries, our own country's pension systems, but I would like to say some words about the emerging markets as a general, their pension system. So for example, in emerging market countries, defined contribution plan assets represented on average about 90% of total pension investments as of the end of 2022, according to the OECD statistics. And you know that the critical thing in the defined contribution plans is that DC plan members are either incapable of making good investment decisions due to the lack of financial literacy or unwilling to implement them due to the behavioral biases such as inertia, procrastination, and present bias. So to address this problem, defined contribution pension plans typically offer default funds not only developed countries but also in emerging market countries like in my country Turkey in auto-enrollment programs or in mandatory programs, and already widely used in the United States. Life cycle funds, also called target date funds, are increasingly becoming the dominant choice as default options in pension plans. And as far as I know from the Vanguard statistics, now default options in the United States in defined contribution plans in 90% offer target date funds in their default options. And for this study, we select 4 emerging market countries to see how we should design target date funds optimally. These are Mexico, Poland, South Africa, and Turkey, my country. They represent different regions of the world and offer default investment options or life cycle funds in their mandatory and auto-enrollment pension plans. So this is an interesting study because these countries represent different regions of the world. They have some exhibit some similarities, but also some differences. So we will see that how to optimize life cycle fund, target date fund structure in these countries. Some literature review is just to explain the main intuition of why human capital is so much important for today's presentation and Chilean target date fund reform. Indeed, this study is closely related with the life cycle theory and human capital, particularly for youngest ages, is our largest asset. But often, like in Markowitz's problem, we try to always optimize only financial capital. So both Viciera, Samuelson, these Nobel Prize winner studies indicate that human capital should be included in the wealth maximization problem of individuals in addition to financial capital. In addition to what we invest like stocks and bonds, we should also optimize our portfolio allocations depending on human capital, not only financial capital. But recent studies also indicate that human capital is not a non-risky asset, it's risky because all of us have some temporary and permanent fluctuations to our career and to our work in our working life. So what are these temporary and permanent fluctuations? Indeed, I would like to mention about them. For example, these can be positive or negative shocks to our future labor income, to our future wages. For example, you're working in a construction industry and you have to, for example, have some short-term unemployment, which is a temporary and negative shock to my future labor income. On the other hand, I can get a promotion in my job, which means that this is a positive and permanent shocks, which permanently changes my subjective life income, my subjective wages. So these permanent and temporary shocks are really critical in the design of human capital, which means that human capital is risky. Since it's a risky asset, it could be also correlated with stocks and other risky assets. So the main intuition which this literature shows us that human capital should be added into the wealth maximization problem, but as a risky asset, not as a non-risky asset. So some equations, but they are very simple. I would like to indicate them in a very basic way. So as far as I mentioned to you, labor earnings, our wages are not deterministic. They are subject to temporary and permanent shocks. And according to the very famous study by Coco Gomez and Menaut and Viciera, these earnings can be modeled as logarithmic income, which is equal to deterministic labor earnings, which is our labor income profile, but plus permanent shocks and temporary shocks. The main critical thing in this study, and I think for every country, we should model these temporary shocks and permanent shocks very detailed way. So we took some temporary and permanent shocks magnitude from the literature here. But I think for the Chilean target date fund reform, also for other countries, we should have microdata, cross-sectional household budget surveys to understand these temporary shocks and permanent shocks in a very clear and detailed way. But when we model these temporary shocks and permanent shocks in a very basic way, I can tell you that temporary shocks are equal at every wages. For example, I am at age of 35 and you are at age of 60. Our temporary shocks are equal at every wages. But permanent shocks are different. Permanent shocks increases with age, cumulatively increases with age. This means that a worker who is 60 years old have a very, very large permanent shock compared to a worker who is 25. And these permanent shocks, of course, affect the portfolio allocation of target date funds in a critical way. So just to illustrate you why this labor income profile or human capital is very important. So in our study, by the way, human capital means that discounted future value of labor earnings. So discounted future value of our wages. If we sum up and discount our future wages, we can now reach out our human capital now at time t. But of course, this human capital is risky, so we will discount stochastic labor income and we will see that. But for the deterministic labor income, just to show you that which countries have different and similar labor income profiles. For developed countries and emerging market countries, you can see that while they exhibit some similarities in their labor income shapes, they are also different. For example, you can see the Belgium. After the age of 50, labor income continues to increase in Belgium, which means that human capital is still dominant at this age. So the portfolio allocation of life cycle funds and target date funds should be very different in Belgium than Ireland or Japan or Denmark. And although they are all developed countries, their labor income profiles differ too much. Again, in emerging market countries, Slovenia, Turkey, and Thailand, also they have some hump-shaped curve. But after the age of 50, for example, in Slovenia, labor income decreases very sharply. This means that the importance of human capital is very different in Slovenia than Turkey and Thailand after the age of 50. So these differences, critical differences, shows us that different labor income profiles should yield different results in terms of portfolio allocations of target date funds. And when we think that human capital is also risky, we will see that these countries exhibit some differences in their target date fund design, should exhibit some differences in their target date fund design than typical US target date funds. So from labor income to human capital, as far as I mentioned, stochastic human capital means that sum of discounted future labor income to today. But we will discount this stochastic labor income to today with a risk-free rate and risk premium of human capital. But we will see that this risk-free rate, discount rate, is not so much critical in the design of target date funds, which is a very, very advantageous for our study because indeed modeling discount rate is another important topic. So, but we will see that discount rate is not so much critical in the design of target date funds, so that we could exclude this risk premium of human capital, as we will see. So we have stochastic labor income. We discount it today with a risk-free rate, and now we will see, first of all, labor income profiles by country and age group, and then stochastic human capital. First of all, this chart illustrates for four countries, Mexico, Poland, South Africa, and Turkey, real annual learnings which are standardized to the age of 15 to 24. You can see that South Africa, for example, has a different labor income profile because since the unemployment is higher in the younger ages than older ages, in South Africa, the labor income continues to increase after the age of 45. The other three countries exhibit hump-shaped curve, but even they exhibit similarities in their labor income profiles, we will see that they exhibit some differences in their optimal portfolio allocations. So these are in our study, four countries, labor income profiles, annual real earnings standardized to 100 for the age of 15 to 24. What about capital market assumptions? Because we won't optimize on human capital, but we will also, of course, optimize financial capital. These are annual real capital market assumptions, expected return, standard deviation, and correlation coefficients for these four countries. You can see that while Mexico and South Africa have more similarities in terms of their capital market assumptions, Poland and Turkey have more similarities in terms of their capital market assumptions, and we will see these similarities also will yield some similarities in their optimal design of target date funds. Okay, now let's start with human capital. I always try to emphasize human capital, and what it looks like. In this is for Mexico, which is similar to Chilean country, first Latin American country in our study, Mexico, stochastic human capital for different ages. Age 20, age 30, age 45, and age 60. Indeed, this was deterministic labor income because we know for each age group which wages should be taken. But here, since it's stochastic human capital, and we assume that the labor income is risky with temporary and permanent shocks, it has some distribution because it's risky. In stochastic human capital, you can see that age 20, age 30, and age 45, the median of human capital is higher than its standard deviation. But for the panel D, age 60, the standard deviation of human capital is higher than median. Why? This is the perfect illustration of permanent income shocks. These permanent shocks, as I mentioned to you, affects older ages more than younger ages because it's modeled with AR1 process and it increases cumulatively with age, which means that at age of 60, a worker have a very large permanent shock compared to a worker who is age 20. So in this respect, the standard deviation of human capital for a worker age 60 is higher than age 30, age 45, and age 20. You can see the ratio between standard deviation to median human capital for different ages are different due to the effect of permanent shocks. This is for Mexico, but the same situation is for Poland, as you can look at the age 60, as you can look at the South Africa, and as you can look at the Turkey. But I should indicate that we took temporary and permanent shocks equal for every four country to compare only their capital market assumptions differences and also their labor income profiles. But the shocks are same. So temporary and permanent shocks are the same because we do not have any micro data for these four countries and it's a very comprehensive analysis. But this brief is just to illustrate simplicity why human capital is so much important in the design of target date funds for every four country and for every country indeed. And as you can see for Turkey, South Africa, Poland and Mexico, the effect of permanent shocks are really high. And due to this fact, standard deviation of human capital is higher than its median for the age of 60. Okay, we have stochastic human capital here for four countries. We have capital market assumptions with expected returns, standard deviation, and correlation coefficients. Now, we optimize these optimal equity allocations in life cycle funds since a worker can invest in only two assets in our ecosystem, bonds and stocks, to make it very simple for these four countries. And here are the assumptions for our optimization problem. Starting age of investment for a worker 20, retirement age is 65, risk aversion coefficient is 5, discount rate is 5%, contribution rate is 10%, and standard deviation of temporary and permanent shocks, as I mentioned, are same for four countries, 13.89% and 10.95%. These were taken from very famous studies from the literature, and generally they took these permanent and temporary shocks levels in their in the academic and non-academic literature. So what about the optimal equity allocations in life cycle funds, optimal portfolio allocations? As you can see here, while a worker invests in equities and bonds, this means that the other part of the equity allocations is allocated to bonds. The allocations to risky assets varies from country to country, but we can see that Mexico and South Africa have some more similarities in their equity allocations than Poland and Turkey. Maybe you remember I mentioned that in terms of their capital market assumptions, these countries, Mexico and South Africa, have some similarities, particularly in their stock market volatility, and Poland and Turkey are much more similar. So these capital market differences are already reflected in this design of target date funds, but not these differences only stem from, of course, financial capital. Also from human capital, their labor income profiles, we draw there. Since shocks are equal for every four country, if we think that even the shocks are different for and modeled for these four countries, these differences should be higher for these four countries. But what can I say at the first stage is that for four countries, optimal equity allocations are far away very different from US target date funds. Because as you may know, in US target date fund design, for several decades, 90% of equity allocation continues in the youngest age cohorts. And then it decreases for the pre-retirement period. But in our analysis, as you can see, only in Mexico and South Africa, 100% of equity allocation only continues for the up to the age of 29, and they decrease. And even for Turkey and Poland, it decreases from the youngest age cohorts. Even the youngest age cohort in Poland, for example, do not invest 100% of equity in life cycle funds, in target date funds. So this is, I think, the most important critical point in our study. When we design target date funds optimally with human capital, risk human capital, and financial capital with their own capital market assumptions, the situation is very different than US target date funds. This situation shows us that as emerging market countries, Latin American, Central Eastern European, or any other country, we shouldn't mimic developed countries' target date funds in our markets. Because according to the CRRA utility function, these are the optimal equity allocations that can optimize the utility function also. But US target date funds are far away from this shape. So you can ask me that, what about the sensitivity analysis? Because here, as you can see, we assume some assumptions like risk aversion coefficient, discount rate, contribution rate. We already did a very comprehensive sensitivity analysis. For example, the first sensitivity analysis is for discount rate. As you may remember, I told you that indeed the risk-free rate and risk premium of human capital is not so much important for optimal design of target date funds. Why? Because as you can see, for 4 countries, indeed, the differences are not so much wide. The differences are very limited for these 4 countries, varying discount rates. For varying discount rates, you can see that they exhibit very similar optimal equity allocations. This means that discount rates have limited impact on the design of target date funds, and it's a very, very good I think indication, because you know that modeling discount rates are really hard, particularly in emerging market countries. What about contribution rates? We assume contribution rate is about 10% for these 4 countries, but as you can see, as contribution rate increases, the optimal equity allocation decreases. Why? When we think in the sensitivity analysis, we should indeed think about the balance between human capital and financial capital. Contribution rate increase means that financial capital now is more dominant than human capital in the case that contribution rate is low. So this means that when contribution rate becomes high, financial capital can be more dominant than human capital, and financial capital decides the optimal equity allocations more than human capital. So this means that since financial capital is also risky in most of these emerging market countries than human capital, particularly in the youngest age cohorts, optimal equity allocation decreases. But as you can see, at the age of pre-retirement period, 60, 64, the optimal equity allocations are very similar. Why? Because here human capital is almost zero, and financial capital almost indeed decides the optimal equity allocations. What about risk aversion coefficients? We assume risk aversion 5, and also I would like to indicate that some of the studies reported that risk aversion also changes with an age. Older investors may have different risk aversion coefficients than younger workers. But in this study, we assume it's constant. This is another research topic indeed. We can consider for another brief for the CFA. But from now on, we can see that, of course, risk aversion coefficient only affects the financial capital of our wealth maximization problem. And this means that when people becomes more risky, of course, optimal equity allocations will decrease. And indeed, in emerging market countries, it's a very important parameter. So it's very important to capture workers, investors, risk aversion levels to optimally design target date funds. So what about permanent shocks? As I mentioned, temporary shocks are equal at every ages, but permanent shocks are increasing cumulatively with an age, which means that it really also affects the optimal equity allocations, particularly for countries which have already higher stock market volatility. Indeed, permanent shocks is about human capital riskiness, but as I mentioned, and you will see, they can be also correlated with stocks. But from now on, if we think that it only affects the human capital riskiness, as human capital riskiness increases, which means that optimal equity allocation decreases. Because human capital always particularly when it's less risky, always act as a buffer for investors, like a bond asset, a low bond-like asset. While it's risky, it's more bond-like asset still. But when we increase this permanent shocks, optimal equity allocations decreases substantially for these four countries, as you can see. Okay. We see that human capital is risky. Permanent shocks, when we increase permanent shocks, optimal equity allocation decreases for every four country for each age cohort. But this is, I think, the most interesting part of the study, correlation coefficients. Because as I mentioned, since if human capital is risky and we assume that it's risky, it's more realistic if we assume that it's risky according to the academic and non-academic literature. If it's risky, it can be correlated with stocks. But it can be correlated with stocks negatively or positively. When it's correlated with stocks negatively, this means that from the Markowitz perspective, it provides some diversification. You know, if two risky assets are negatively correlated, this means that it can increase your risky asset benefits because it provides you some diversification benefits. So with the same logic, you can see that when human capital is negatively correlated with human capital and stocks are negatively correlated and more negatively correlated, optimal equity allocations increases. But when we come to the positive correlation, the most interesting part of the story comes in because after the correlation of 30%, workers should exhibit increasing optimal equity allocation, not decreasing optimal equity allocation, starting from zero. So this is, I think, the one of the most important part of this story because the human capital and its correlation with stocks should be modeled in a detailed and clear way for every country, including Chilean target date fund reform. We need again, I will say that microdata, household budget survey data, to see how human capital correlation changes with stocks, with negatively or positively, with different socioeconomic groups, with different genders, with different business sectors. We should see that how these human capital correlations could change with stocks, because after the correlation 30% in our study, you can see that optimal equity allocation for youngest age cohorts decreases to zero and it increases with an age. So before coming to the conclusion part, just one small exercise, I think, which is also very important for the Chilean target date fund reform, parameter uncertainty model. I will just basically explain the parameter uncertainty. In addition to human capital risk, we also added parameter uncertainty in our brief, this study, which means that we couldn't indeed know financial capital assumptions in a very clear way for 50 years or 60 years. This means that expected return and variance has also some variance. So we are calculating here the variance of expected return and the variance of variance. This is called parameter uncertainty in the academic literature. And from the long run perspective, it's very important for long run investors. So since retirement modeling and this target date fund reforms includes long-term investment horizon, we need to also include this parameter uncertainty. And we indeed obtain variance of expected return and variance of variance with 100,000 of Monte Carlo simulations. And as you can see, no parameter uncertainty, medium parameter uncertainty, and high parameter uncertainty. Parameter uncertainty have much more effect on countries like in Turkey, where stock market volatility is high. If you think that in Latin American countries, also in other emerging market countries, the stock market volatilities can be higher than this picture, I think parameter uncertainty, incorporating parameter uncertainty into design of target date funds are also critical. These are appendix from our study, but also to see the robustness of our results. So we conduct Monte Carlo simulations for calculating stochastic human capital, financial capital, and parameter uncertainty model. With all these models, we conducted 100,000 of simulations to be consistent. And as you can see, even for 1 million simulations, the results are very similar for these four countries. These are simulated wealth accumulations over different investment horizons with 3D graphs. You can see here accumulation, investment horizon, and simulation numbers. to see simulated value accumulations. These are up to only 10,000 simulation numbers to illustrate you in a more clear way the pictures. And these are the expected human capital and financial capital accumulation by age, by country. As you can see, some volatility in the human capital in the yellow part. Since the human capital is also stochastic, you can see some variance also in the yellow part. You can tell me that also financial capital is stochastic, so why it's not so much volatile? Because human capital becomes so much volatile that even in thousands, hundred thousands of simulations, we couldn't reduce this volatility in the picture. So conclusion, labor income profiles for different emerging market countries and capital market assumptions significantly impact life cycle fund target date funds allocations. Risk aversion, permanent income shocks, correlation between human capital and stock returns strongly influence investment strategies. When human capital and stock returns are positively correlated, younger investors may benefit from higher equity allocations, with stock allocations increasing later in life. And contribution rates and discount rates have a relatively limited impact on asset allocations. And parameter uncertainty leads to more conservative equity allocations, particularly in countries where stock market volatility is high. Some policy suggestions. So first of all, since human capital is very critical, we need to model country-specific and sector-specific labor income patterns, its riskiness, and its correlation with stocks with a microdata. For this, for every country, not only in Chile, but since Chile has a target date fund reform, I will tell you that. We need household budget surveys data for both cross-sectional and panel data for different years. I think this is very critical to model in a detailed and clear way Chilean human capital. I think this can be a very efficient way to model the human capital, stochastic human capital in Chile, with temporary and permanent shocks that are only related with the Chilean labor markets. The second one is addressing parameter uncertainty in EM countries. This is a very neglected topic. So in this brief, we also emphasize the importance of parameter uncertainty, because we know that financial capital market assumptions cannot be sustainable for long-term horizons like 50 years or 60 years. So this is very important for emerging market countries where stock market volatility also is high. And policy support for cost-effective and efficient default options. So, for example, in my country, in Turkey, we introduced auto-enrollment, but unfortunately, our default option is interest-bearing funds, still not life cycle funds. So, these target date funds modeled with human capital risk, human capital correlation with stocks, should be introduced as default investment options in mandatory and auto-enrollment programs. Okay. So my last slide is about implications for Chilean new target date fund reform. So if, as pension research and consulting in my company, if we, for example, model the target date funds for the Chile, what we will do? So we recommend then indeed adopting an integrated approach that combines stochastic simulation of both human capital and financial capital, like in this study. But we will use dynamic programming techniques, not static, of course, and with different stress testing to construct age cohort specific reference benchmark portfolios. Also, in our target date fund practice, as you see, we indeed use constant relative risk aversion utility framework, but also we can allow for different utility frameworks, like different utility functions for different and heterogeneous participant profiles. And we will use stress testing under for adverse macro financial scenarios for building up an efficient retirement income for those who are encountered with, for example, stock market crash. And for portfolios involving multiple asset classes, because in this study we only include two asset classes to be simple and to see the importance of human capital, stocks and bonds. But for involving multiple asset classes, we apply grid search optimization techniques in financial softwares to efficiently solve the optimal asset allocation for assets at a high dimensional space, like private equity funds, infrastructure funds, real estate. So we can include as many assets as we can. And while remaining sensitive to human capital, participant characteristics, regulatory frameworks, and evolving market conditions. So thank you so much for your patience. I hope you enjoyed the presentation, and I will be pleased to have your questions.
Great. Thank you very much, Dr. Sia, for your presentation. Whoever want to make a question, please feel free and to raise their hand in the react button at Zoom. But first, we have a question in the chat by Maria Alicia Montes, in which she mentioned us or asked us about what was the function that was maximized for the optimal allocations.
Thank you so much. In my slide, I think we have a simple illustration of that. Indeed, we are maximizing both financial capital and human capital with a constant relative risk aversion utility maximization framework, which means that 1 minus risk aversion coefficient is divided by 1 minus risk aversion coefficient. But what we maximize is the sum of financial wealth and human capital.
Sorry, is the maximize for each period or for the whole of the
Yes, single period. Yeah, single period.
single
It's
period.
not, yeah, single period. It's a static now indeed maximization problem because to be as simple as possible for these four countries, we use static method for single period optimization method, but we are considering for a new reform indeed dynamic optimization techniques, which are, much more complicated, but can be much more reliable.
So it doesn't have a target replacement rate or anything at the end of the working life.
We did not calculate it. Indeed, the study is very long. We do not consider like target replacement rate as anything, but indeed we can calculate the retirement wealth distribution for investors and how their utility maximization and can also change compared to other investment alternatives, such as, for example, 100 minus H rule or 60% of stocks and 40% of bonds. Indeed, as a next step in my also other article, what we did is that to evaluate the performance of these target date funds with other investments and traditional investment alternatives. Not with target replacement rates, but retirement wealth distribution and utility maximization framework.
Okay. I have lots of
Thank you.
questions, but I will let someone else ask, and if not, I
Okay.
can go with the rest of my.
Okay.
Okay, in the meanwhile that we wait some question. Okay, Nicolas, please go ahead.
Yes, thank you, Seda, very much for your presentation. I have a couple of questions. The first one is related to alternative investments. Have you figured out how to include in this optimization problem the use of alternative investment? We have here in Chile an important part of the portfolio of the pension funds now invested in that kind of investment. So if the answer is not, is any way to optimize this process in order to consider that? That is the first question. The second one is related to some parameters that you're using. You mentioned that some of them are time dependent. I understand that you are using like static parameters. You did a kind of sensibilization, sensitivity analysis, but can you adapt the model to acknowledge that some parameters are time dependent? So, for instance, risk aversion.
Dynamic, you mean?
Yes. It's different at the beginning of the life cycle versus the end. That is the second question. And the third one is related to how, in practice, you did some estimation for some countries that we have empirical executed glide path in the system. So, how are your estimate compared to what was executed in Mexico, for instance, or any other country?
Thank you so much, Nicolas. First two questions I will answer, and for third one I will indeed ask for a clarification. But the first two, the first one is we will use grid search optimization technique, indeed, to include alternative assets. Indeed, also AFP Association of Chile asked for this. How do you include these alternative assets into the optimization problem? It's not so much hard, indeed, use grid search optimization techniques. While it makes the optimization problem process slower, we can do it. It's not a problem. But as far as I try to emphasize is that the most important thing is to include human capital as an asset. So we can include alternative assets in a very easy way, but indeed modeling human capital is the most critical part, what I try to emphasize in this presentation, because we can include as many assets we can, but modeling human capital as an asset class is a critical part because we need, as I mentioned, microdata, household budget surveys. So the most critical part is to model indeed human capital. Then with grid optimization method, we can include as many assets we can. So even it's slower, we can do it. For your second question, I'm sorry, your second question is about?
Was about the some parameters are time dependent if you are
Yes,
considering
we
that
can
in
do
the
it dynamic, and it's very interesting to see that while studies with only human financial capital, I am sorry, take some dynamic optimization problem. With human capital, we didn't see any dynamic programming techniques which takes also human capital because it's hard to optimize dynamically human capital plus financial capital. But in our next study, we will definitely try this. And this is also in our notes because I think dynamically programming human capital plus financial capital will be a great thing. So both of the aspects, because as far as I know, in academic and non-academic studies, most of them only dynamically programming, time dependent, the financial capital, not human capital plus financial capital, and we will consider this. And I'm sorry, I will ask for question 3 again.
No, I mean, you are estimating some glide path for some jurisdiction or country that have implemented this glide path already. So how is the distance of the gap between what you did in this paper and what have happened in practice?
Great question. Okay, great question. Indeed, it's very similar what I try to emphasize. Indeed, generally, my country and included countries are trying to mimic US target date fund design. You know, for several decades, for youngest age cohorts, they continue with 90% of equity allocation and then they decrease. So most of the glide paths are taken this US mimic style of target date funds, but it's not correct. As you can see that indeed these shapes, these optimal equity allocations shapes are really, I will again show you. These optimal equity allocations, glide path structures are very different than US target date funds, as you may know. So because in the US target date funds, these allocations are continues to be like 90% up to the age of 40% or 45% in like Vanguard, Fidelity Investments or T. Rowe Price glide path design. So this is why we try to emphasize that these countries should not mimic US type of developed countries target date fund glide path design. And instead of this, they should construct their own model with their human capital and financial capital.
Great. Thank you, Dr. Seda.
My
And
pleasure.
also, I would like to recommend interview. Today, Diario Financiero published an interview of Dr. Seda about this topic, and so we recommend to read that interview. Maria Alicia, you have another question?
Yes, I wanted to know, well, since this is only a single period, I guess that it's difficult to include, but for example, all the social benefits, if you have a pay-as-you-go kind of benefit at the end, that should be included into and that's kind of bond-like, so probably should change. Another thing is, how do you consider, since these are emerging markets, the informality in the labor market? Because in these cases, you have human capital, but it's not changed and it's not accumulated into financial capital when you don't contribute. And it's difficult to turn it on that side. And on the other side, you said that contribution rate didn't have an impact on your model in the allocation. But usually what I've seen is that when you have and when you target a replacement rate more than the maximization of the total wealth, usually when you have very low contribution rates, since the replacement rate is so low, you should maximize the return in order just to have some replacement rate that is significant or could be increased. But when you have very high allocation contribution rates, since the financial wealth accumulates quite fast, then in that case, you can be more conservative with your investments. So
Okay.
are these kind of things considered in your model or not, or how should they be?
Thank you so much for these important questions, Maria, indeed. I will start with the third one. Indeed, contribution rates affect the optimal equity allocations in our model. Discount rates have very limited impact, indeed. They have not so much impact, but as you can see here, contribution rates have also impact more than discount rates in the optimal equity allocations. And as contribution rates increases, the optimal equity allocations decreases, since now the funds are much more invested into financial capital rather than human capital. So this is the result for your explanation for your third question. For the second one, I think it was about labor market informality. Am I right? The second one.
Yes,
Yeah.
the informality.
For the second one, this very important question, and also I think very important for the Chilean new target date fund reform. What we model, why it's I'm saying that critical for modeling temporary and permanent shocks is that when we model these temporary and permanent shocks, we are also including this labor market informality. I know that there is no regular contributions for the financial capital, and we are ignoring it in our studies, and it's very important. But for these non-regular contributions, we are already incorporating these temporary and permanent shocks, which makes human capital much more risky, for example, in Chile, than in a country which has low market informality. So why it is critical for these temporary and permanent shocks is that we are incorporating this labor market informality into these shocks. This is why we should model them with microdata, because each country has different labor market informalities, different temporary and permanent shocks. So these should be included in the random shocks, temporary and permanent, and we need to model them with a microdata. And I think your other question is about social security benefits. I can send you one of our studies, which is made for Society of Actuaries. This was a very comprehensive design of life cycle funds, which also includes the accumulation phase. And as you mentioned, we saw here that for the United States pension system, we model it. What we see is that for the decumulation phase, the equity allocation, as you said, increases because social security benefits acts as a bond-like asset. So definitely it should be included. And in this study, we included it. And what we saw is that in the decumulation phase, optimal equity allocation increases due to the social security benefits. In this study, we also include many other parameters, such as longevity risk, which is very critical, such as bequest motive, because some, people will like to inherit their wealth, financial wealth. This is another point. Longevity risk, social security benefits. We also included some annuities. So this was a very comprehensive study, but for only one country, United States. So this indeed brief's main aim is to show with similar assumptions how glide path designs can be different due to the different human capital risk, due to the different labor income profiles and capital market assumptions for these emerging market countries. But I can also send you this study, which also includes social security benefits.
Thank you. Of what I see, the design of it depends on a lot of things. So this framework would be very good to design the glide path for any individual person.
Yes.
But since the glide path will be designed on a nationwide, and it will be only one glide path for the whole of the country and should be stable in time, this kind of seems a challenge because, as you show in your study, it depends on a lot of things that depend on each person, on the
And we
human
need to
capital,
assume
on the
many
contributions, and so on.
Yeah.
And of course, in an illiquid market, since this shows that you should change the glide path depending on your reality each year, it's very difficult to get something that is across wide and for one size fits all.
Yes, that's great. And what can I say here is that you are so right. But I think when we design, for example, assuming a glide path design, for example, let's consider this as a glide path design for these 4 countries. But what I can say is that even these assumptions with glide path design is much more credible and efficient than the design of target date funds mimicking than the United States ones. So I think the main critical thing is that not to mimic US type of target date funds into the emerging market countries, because they have, as you see, many different labor income profiles and many different capital market assumptions. But even if we assume something that this is better than the mimicking the US target date fund design, but you are right. But in my opinion, I think there should be more than one target date fund design, at least for parameters that differs too much. Maybe for different socioeconomic groups, but maybe also for business sectors that have very, very high human capital shocks. Because the parameter that's affected too much is the positive correlation between human capital and stocks, as you can see. So, for example, for different business sectors that have very, very high human capital shocks, I think the design should be different, at least for this parameter.
Thank you.
Thank you so much.
Great, thank you for your question. Please, if someone has another question, please feel free. And in the meantime, I would like to ask you about one of the findings in your study is, again, the correlation between human capital and stock market. And it looks like these countries of this emerging market have a very high home bias. In the Chilean case, there is a home bias in the fixed income, but in the equity side, it's more abroad and more global. So how should Chile took that into account, and without being overly conservative and considering the possible correlation with the human capital?
That's great. So, indeed, here again, I think the home equities and abroad equities correlation with human capital should be calculated differently in a very clear way. Because as their correlation changes, it can also provide some diversification like negative correlation, or it cannot provide diversification benefit in the case of positive correlation. So these correlations should be calculated separately to decide whether the home equities or abroad equities should be included in the design of target date funds and for which percentage. I think it's very important to calculate them. So the correlation part is very critical. And also, I think there is one question from Philip. Am I right, Pedro?
Yes,
Ah,
Felipe Widroburo is asking us of how do the results change when the retirement age goes up?
Thank you so much, Philip. Indeed, that's great. So, when the retirement age goes up, we can say that financial capital decides the optimal equity allocation at the end of the story. So, we have again one period period portfolio optimization function. So the results just change that indeed the periods are not similar, maybe 5 or 10 years later. But at the end of the story, financial capital decides the optimal equity allocation. I can tell you that.
Okay, perfect. And one last question again about, in fact, Nicola also mentioned that Mexico, many of us are looking Mexico because of our similarities, since both are in Latin America, and the Mexican pension system took base of the Chilean pension system. What would you say that are the main differences that we should take into account in making that change into life cycle funds that made Mexico, that we should repeat or not repeat in the case of Chile?
That's great. We also, designed the similar target date funds for Afores in Mexico, indeed. And we took the same approach. But when we look at the Mexican target date fund design, while they took the age parameter, they did not carefully design the human capital. Again, as I said, we can include as many assets with great optimization procedure, and it's not a problem. But the main problem and the main critical is to model human capital, its riskiness and its correlation with stocks. I think what Chile first of all should do that is to model human capital in a very clear and detailed way with household budget survey data. So we need to include this economics concept into this financial design in a very proper way. So what should Chile do different from Mexico is to clearly and detailedly design this human capital for Chilean workers.
Perfect. Thank you very much, Dr. Seda Peksevim.
It's
We are
my
running
pleasure.
out of time. So again, thank you very much for your time. Thank you everyone for joining us. And any question that may arise in the future, we will be more than happy to make follow-up with Dr. Seda. So thank you very much for connecting, and thank you again, Dr. Seda, for be so kind to be with us today.
Thank you so much. Thank you very much, Pedro, Javier, and Natalia. And for all our participants, thank you so much.
Thank you. Bye-bye.